The real issue now is we have got rising interest rates, which are out of control. The central banks can't control it, and it will break the system. And that is something that's going to happen in a matter of months, possibly even weeks.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. This distinguished returning guest is one that our viewers always ask to have back often. Alasdair MacLeod is the head of research at goldmoney.com. He's also a former director of a bank. He joins us this Thursday, February 10th, 2022. Alasdair, thanks for coming back on Liberty and Finance.
That's my pleasure, DK.
When we've had you on in the past, you've cautioned us about the impacts of runaway inflation on our currency and the destructive effects that has on people's savings, their earnings, their retirements. We want to get an update from you on that today, but first, if we could ask you, and then we'll get to some viewers' questions that have been submitted ahead of your arrival, an article you just wrote on the difference between growth and progress, why it's so important for people to understand from an economic basis and a monetary basis the difference between economic growth versus progress. Can you clarify what distinction you're making in your latest article and why that's important to the ordinary person?
Yes, sure. The idea of economic growth is a complete non sequitur. It's not economic growth at all. It's growth in the quantity of money in the economy being deployed. And obviously the purchasing power of that money is the thing that matters. And the more money you put into the economy, the lower the purchasing power of each individual currency unit. So you can forget that GDP, which everybody targets, is actually meaningful. It is meaningless. Really, I think what people are confusing it with is economic progress. Now, progress, I think we can define as an improvement in the condition of the average person from, if you like, the march of technology, of profit-seeking entrepreneurial success, and so on and so forth. Those are the things that contribute to economic progress. It is not, as everybody thinks, wrapped up in a GDP number, which is simply a monetary total. Money doesn't tell you how it's spent. It doesn't tell you the quality of what it is buying. It doesn't tell you whether or not it's improving people's lives. And I think that's the point which everybody really should hoist on board. And I would urge your listeners, your viewers, to go to that article and read it through and really make an attempt to understand the distinction, because it is desperately important, because it is leading to a major policy error.
In that article, you go through several steps of explaining the difference between growth and progress. Could you go ahead and outline the key points here and then draw the connection to how people, you say it's critically important. How is it important to the ordinary person?
Well, the first thing to note is I have one chart, which is figure 1 in the article, which shows the growth of GDP and the growth of M3, taking that as the broadest measure of money, which I know that the Fed doesn't follow anymore, but it is actually compiled by the IMF. So those figures are available. And I've rebased them to an index of 100, and I've put it on a logarithmic scale. And you can see that until about 1990, I think it was about 1990, they actually moved very much together. Then after that, you found that M3 didn't keep up with the growth in GDP. Now, that gap, to a large extent, I believe was due to the emergence of shadow banking as a major factor in the economy. Because 1985, we had Big Bang in London. Wall Street followed, deregulating banks in the sense that Glass-Steagall was thrown out the window and all the rest of it. And the hedge fund industry started going. And that was, if you like, an indicator of what was going on in the shadow banking space. Because, again, falling interest rates over that period meant that everybody, all the major institutions in the system sought ways to increase their income because of the declining in interest rates. And one way of doing this was shadow banking activities.
On that point, because that the term shadow banking is intriguing, but it probably is much more clear to you what you mean by it than to the rest of us. So could you please help us understand what you consider shadow banking and give us some examples of that?
Okay. Well, shadow banking in the widest sense is the recycling of money, if you like, through money and credit, or currency and credit, through various institutions. And these vary from money funds to pension funds to insurance funds to investment management outfits, to collective investment schemes. I mean, the whole plethora of the financial establishment recycles its money, and some of that, only probably a relatively minor part of that total, is involved with the creation of credit, and it's that bit that we really we really want to focus on. To give you an example, I remember well in the early noughties, we had banks would issue funding, or funding limits rather, off balance sheet. We'd get a vehicle quoted, say, on the Channel Islands Stock Exchange for $1 trillion. Hold on, this is huge. This is absolutely enormous. But what it meant was that they could use this as off balance sheet finance to expand their amount of lending for profits on the bottom line. And all sorts of banks were doing this. I mean, particularly around Europe. They were also doing it in America, and roughly 40%, I think, in the early days of shadow banking. The shadow banking was in the United States. And I'm going on figures which are compiled by the Bank of International Settlements. So if you like, if you take M3 and add in a factor for the credit creation aspects of shadow banking, then you can see that the red line on my chart, which is of M3, would actually marry up with the blue line, which is GDP. We then had the financial crisis, 2008, and at that stage there were changes, because with the collapse in the stock market in particular, that meant that the size of shadow banking fell. Not only that, but the securitization, some of them failed completely. These were securitizations of mortgages. They failed completely. And furthermore, the regulations changed, which meant that a lot of the shadow banking, which was off balance sheet, off the bank's balance sheets, was brought in. So we had a situation really where it was a combination, if you like, of the figures being more accurate as far as the statistics are concerned, and at the same time, an enormous monetary stimulation by the Fed. Remember that the Fed was starting doing QE quite seriously in the wake of the Lehman crisis. So at that point, M3 started growing more rapidly than GDP. And we then go up to September 2019, when we had the repo crisis. And, most people have forgotten about that. Why? Because it was beautifully covered up. I mean, we were aware that suddenly the repo rate jumped up to 10%, and then the Fed came in and pushed it down. Panic over. So, that was a 5-minute wonder. But actually, it was extremely important. It would mark the beginning, if you like, of the destabilization of international banking, because the banks that were involved in that were basically Eurozone banks, in particular Deutsche Bank and BNP, the big French bank, because Deutsche Bank sold its prime dealership to BNP. And that was the day in which ownership actually changed. That was what drove, or it was a pure coincidence perhaps, But I don't believe in coincidences except as a last option. That was the day in which, in that September, the repo rate jumped suddenly to 10% one morning and was then jumped on. So that was the first sign, if you like, of a banking crisis in the making. And we then go on from there. We had a crash in the on the S&P. I mean, it fell. We forget, but I think between something like February the 8th, 2020, and around about the 20 to 23rd of March, a period of 5 weeks or something, 5-6 weeks, the S&P lost fully 1/3 of its total index value. I mean, a whole 1/3. And it was then, of course, that, first of all, COVID was really beginning to undermine things. And that March date was when the Fed decided to cut interest rates, its Fed funds rate to zero. And it then followed that with QE of $120 billion every month, which is monetary injection into the system. Now, at that point, the relationship between M3 money supply and GDP, M3 just took off relative to M3. And it is now, I mean, I've got this on a logarithmic chart. And I think from memory, we're looking at figures like M3 is running at something like 1,500 on this indexed chart, whereas we've got GDP at around about 700. So there's a huge, huge gap. Now that indicates the amount of monetary inflation which is in the pipeline yet to be reflected in GDP. It tells us two things. It tells us that nominal GDP, I mean, forget what the economy is doing, nominal GDP is going to outperform everybody's expectations. Why? Because there's all that money yet to feed through into it from the broad money supply. The second thing it tells us is that we're only seeing the start of the effect on prices. I mean, today we had reported that the CPI was up 7.5%, which exceeded expectations of around about 7.3%. Shock, horror. But that's nothing compared with what we've got in line. And I know that you've spoken to John Williams before at Shadow Stats. And if you look at his assessment of where CPIU should be based on the way it was constructed in 1980, that's now telling him 15%. I mean, so these are huge figures. Now, what does it mean for interest rates? Well, what it means is that anyone buying US Treasuries on John Williams' figures is sacrificing in the sense that he's got a negative yield of around about 13%. And on even on CPI figures, he's got a negative yield of 5%. Now, can this continue very much longer? The answer is no. So you can see that a lot of people are turning around and saying, well, hold on a minute, the money supply growth is slowing down and we've got to be careful. If the Fed goes too quickly, they will crash the economy and all the rest of it. That's not the problem. The problem is that prices still have to reflect a massive monetary impact. And that's shown by the difference on the chart between where GDP is and where M3 is in terms of relative growth rates. So this is a very serious situation, and I would impress on everybody to try and understand it. That is the mistake, really, about GDP. Now, when it comes to progress, which is really what we're interested in, that progress is something which, whereby the average person finds that his life has improved. I mean, okay, he works for it, tough. We've all got to work for it. But if he is prepared to work, he can earn, and not only can he earn, but he gets a better standard of living. That is what progress is about. And it's a combination of entrepreneurial profits, seizing on the opportunities, identifying what people want, identifying what's going to make people's lives better, combination of that and deploying technology. I mean, in theory, we've got it in spades now, but we haven't because they're destroying the whole thing by printing so much currency, to try and rescue zombie companies, zombie governments, and all the rest of it, that we're just being suffocated by current monetary policies. They're doing exactly the opposite of what they should be doing if they had our interests as the people at heart.
The logarithmic scale of your figure 1 that shows the M3 money supply taking off and completely disconnecting from the nominal GDP, it's fascinating twofold. One is that you say that presages, it gives us a forward-looking indicator of future price inflation that has yet to play out in the economy because you've bloated the currency supply and the economy hasn't absorbed it or reflected it yet. That's interesting. The other thing is that the log scale, even on a log scale, from my engineering background, to see that inflection point in the rate of increase in a absolute scale would just be a hockey stick of verticality, and that disconnect, that distance between the nominal GDP versus the money supply is much greater in absolute terms than what it's reflected on a log scale. So just people be aware of that. You looks like you use the St. Louis Federal Reserve Fred website as the source of that data. So this is published data. This is not just.
It's not me making it up.
Yeah. Okay. Well, we've got a lot of people watching, and we've heard such a litany of understatement, or whatever you want to call it, from the monetary leaders saying, "Oh, inflation is transitory or transient," and then, "Oh well, we've got lots of tools we can use to tamp this down if we need to," and that sort of thing. What's your assessment of the ability of the Federal Reserve or any of the other central banks to tame this inflation in any kind of a short term, or do you feel that it's going to be persistent and high level and very impactful in people's lives for some time now? And if so, help us understand your perspective.
Yeah, I mean, the way I'd answer that is they have zero control over the situation. That is now becoming apparent. And we saw this with the change in emphasis from the various statements coming out of the Fed, the ECB, the Bank of England. I mean, it was the ECB and the Bank of England last week. You can see that, they're sort of, you read between the lines and you can see they understand they've got a problem. They're desperately trying not to make things worse. I mean, we had Bailey, who's the governor of the Bank of England, saying, well, in these difficult times, people should not press for higher wages. Come on. They've created the environment whereby people are losing purchasing power out of their wages. And the governor of the Bank of England, instead of taking the blame himself or his organization's blame for this, he's blaming, ordinary people who quite naturally find that their wages buy less. I mean, you couldn't make it up. They have lost control over the situation. And now we have yet really to fully understand that and to fully understand what that means. But I think that's the important point. The second point I would make is if you just sort of think a bit about what I've been saying about GDP and everybody believing that GDP is actually something worth chasing, it is quite clear that they know nothing about economics. They do not know what they are doing. And I would go even further. The whole sort of thing goes around interest rates. And there's a huge misunderstanding about the role of interest rates. Interest rates are not the price of money. I mean, okay, if you're a business and you're trying to do the economic calculation that every entrepreneur has to make before he invests in production and thinks in terms of the cash flow from the final output and all the rest of it, I mean, he's going to try and work out what the cost of money is in order to do that, or what hurdle he will put on it as a rate of return. In that sense, for that particular instance, yes, interest rate is a price. It is the price of capital, if you like, in that sense. But as far as savers are concerned, as far as the depositors are concerned, they lose possession of the money, which means that they need an element of time preference. They're lending money to someone who might not pay it back, so there is a risk element in there. And then finally, what we have is what people are now beginning to realize, and that is that when they get the money back, say after a year, it is going to buy a lot less than it does today. So what's his compensation got to be? That is really what interest rates are about. It's not about the price of money. So interest rates will rise for that very reason. It's not, the idea that you can manage the economy by suppressing interest rates or increasing them or whatever is a complete nonsense, because the whole thing is based on a complete misunderstanding of the role of interest rates. It is not a tool for managing money supply, managing inflation. No way. So you put all these things together, you can only come to one conclusion, and that is that the economic establishment, which advises central banks and governments, is completely clueless. They do not know economics. And I'm echoing actually something that Hayek said about Keynes, with whom he was extremely friendly, incidentally. And he said Keynes is not an economist, he's a mathematician. And, it was a bold statement. And you can search this online and you can see the video of Hayek actually saying this to a television interviewer.
One of the things you've been cautioning ordinary people about for over a year now is the frailty of the fiat currency system. You've just pointed out in this discussion today about the strains that were evident and became obvious to those who knew where to look in the banking system that were coincided with the start of the repo crisis in the U.S. Gary Andrews asks, as far as the impact on ordinary people, what is likely to happen to home loans in the event of a major currency corrections or collapse? He says particularly in the Eurozone, but I guess you could give a general principle there. How are home loan holders likely to be impacted by currency failures or strains?
Well, I'm sorry to say that I think there are two ways in which we are all impacted, if you like, in this. One is that the cost of a mortgage, where you haven't got it fixed for a decent period of time, obviously is going to go up, and that's going to make life difficult for anyone who's got a mortgage, which, particularly if they're struggling to pay at the current level. I mean, the level of gearing through mortgages is the highest it's ever been, really. I mean, it's significantly higher than it was at the time of the Lehman crisis. So that's one effect. And the second effect is we have to bear in mind that in most residential property markets, I mean, I would exclude the real sort of top end, as it were, the sort of $10 to $100 million apartments in the middle of cities and so on. That's not what we're talking about. We're talking about property for the middle and the lower classes, if you like. The problem is that the property owned by those social strata is priced on the basis of the cost of money, the marginal cost of a mortgage. And when that goes up, the capital value goes down. So I'm afraid that, we all need somewhere to live. I think that's the key thing. So you have your house, you have that secure, you've just got to ride through it, because you're not going to ride a crisis out on the street if you could possibly avoid it. So I think that it's going to be pretty painful if you've got the option of getting a fixed rate, a low fixed rate now. I would strongly suggest you look at it. And I think that anyone who has got rental properties and all the rest of it, which they don't live in, which they've got out there as, if you like, as part of their their personal wealth, then that's obviously going to get hit as well. There's a lot of there's sort of some myths about property which are likely to come home to roost. I think if you go back to the big inflation in Germany in 1922 to 23. What happened to property prices then was, they just more or less collapsed. The problem for a lot of it, and in that market particularly, was a rental market. The problem that landlords had was that the rents no longer covered the costs of maintaining the property. And So it really made property valueless, if you like, in that situation. I don't think we've got quite the same problem today, and particularly in America, where there's a far higher level of home ownership. But this is not going to be easy, I have to say. It's not going to be easy. And this is why I say to people, I just hope I'm wrong about this. As time goes on, I feel more and more certain, unfortunately, that I'm right. I don't expect everybody to feel that way, but I would say that really what you need to do, I think, is just have a little bit of an insurance policy by having some genuine money, which is physical gold and silver, put aside as an insurance policy, if you like. I mean, if you think that MacLeod is talking rubbish, and I'm sure a lot of people do, the majority do, then don't neglect maybe just having a little bit of insurance just in case I'm right.
We have a question here from Splashing Tail that follows back onto a theme that we talked with you about several times in the second half of 2021. Please ask Alasdair about his prediction that by the end of 2021, gold and silver would end their COMEX market manipulation because of Basel III regulations changing. They are obviously still monkey hammering the gold and silver prices. What's his current outlook and understanding of that?
Yeah, I think got to be sort of slightly careful. I never said that it would sort of just end like that with the introduction of the net stable funding ratio. It's a situation where banks are likely over time to, if you like, gradually begin to comply with it. Because, I mean, it doesn't ban a bank from running unbalanced positions in commodities or any other derivative. What it does is it makes it expensive to finance unbalanced positions. And so you will get banks management turning around to divisions, trading divisions and all the rest of it. Over time, they will try and discourage them from running unbalanced positions, or at least curtail them to a smaller quantity. And to some extent, the degree to which that happens is perhaps driven by the relative profitability of what they're doing. And there's no doubt that if you look at the gold and silver contracts, both in the forward markets in London and also on COMEX, there are huge profits being made by the bullion banks, wheeling and dealing. Now, against that, they've got the losses on their positions. So they try and contain those losses. But I can tell you from a trading point of view, I mean, they're always going to be short. They will make a lot more money trading than they lose on the other side. So, when that changes, then you're likely to have a change in the situation. And I do think that over time, banks will want to come in line with the Basel III net stable funding ratio requirements, simply from a reputational point of view. A bank which isn't running its finances properly will be seen as, potentially counterparty risk. So, I think market forces will drive it in that direction, but it's not as if suddenly, the regulations come in, bang, you must comply. No, that's not the way it works. What we have seen, I think, and I think this is fair to say, is that the dollar prices or currency prices of gold and silver have been very much suppressed by a number of factors, if you like, relative to what's going on in commodity markets. Now, base metal prices, say, and energy prices, say, are not joined at the hip with the values of gold and silver, but they're a lot more joined to gold and silver than they are to paper currencies. If you just look at the volatility of the price of oil, let's say, measured in dollars compared with measuring it in gold, you can see that, in gold, the price of oil might double, it might halve. But with dollars, I mean, for goodness sake, you can go from minus $40 to currently 90, which is what we've had since April 2020. So, I mean, it's less volatile. And I think that what that means is that as commodity prices continue to rise, and incidentally, metals are really taking off at the moment. I don't know if you're aware of this, but the backwardations in copper, aluminium, I mean, that's just gone through the roof. This is all new. it has been really dramatic, and I just sort of think that it won't be very long before people begin to understand. Hold on a minute, the only protection we've got in this is actually gold. The other story that goes round, of course, is that, gold is yesterday's story. In this new modern world, the way you protect yourself against currency debasement is by buying cryptocurrencies like Bitcoin and all the rest of it. Now, that, I am sure, has taken quite a lot of the speculative punch out of gold buying. And from my view on that is, thank goodness. Because the last thing I want to see is speculation in gold. And, okay, it's given the bullion banks a temporary reprieve, if you like, on their short positions, because, the speculators have gone elsewhere. But I think when it comes to, a sound market in the future, I think gold and silver will be far better for having this very volatile demand factor all pushed into cryptocurrencies like Bitcoin. So I think we're on the cusp of change. There is if you like, a technical pattern where the sort of the top line of a triangle is coming down to around about 1850. We're currently about 1840. So, it's looking like another challenge. It may not get through immediately. It might, they might push it back and all the rest of it. But I think that game is getting very long in the tooth as far as the establishment is concerned. And I think the idea that they can continue to suppress gold, that I think is a story which is now coming to an end.
Let me see if I can understand this in just a few words. If the Basel III net stable funding requirement puts a cost, whatever it is, 15% carrying financing of that on your books, then there's a cost of doing business of this method of trading which has been purported to be happening. However, the method of trading has been so insanely profitable for so long that it's still worth it, even given that official cost of doing business there, but that there may come a time soon when that 15% cost is considered too burdensome, or that because the market is running away of its own organic supply demand driven accord, that the old game doesn't work anymore.
Broadly that I think is right. I mean, there are other factors. A bank might have enormous corporate business, and it would also expect to gather other business on the back of corporate business, say in the large mining companies. And when it's doing that, it will presumably want to have the facility to be able to help, a mining enterprise hedge its positions in this, that, and the other thing. Now, it can do that off balance sheet quite legitimately if it's logged as a client and there's absolutely no other liability other than a client bank relationship between the client and the market. But banks they like to take things on balance sheet where they possibly can, and in many senses it's cleaner. It gives them more opportunities for skinning the cat, if you like. So there are a number of factors, and I don't think I'd get hung up entirely on this Basel III thing. There's still some Basel III stuff coming through. I mean, they call it Basel IV, and this is sort of attacking other elements of risk, if you like, in banking. So this regulation is an ongoing thing. But I think another reason not to get too hung up on it is exactly the same reason I wouldn't get hung up on central bank digital currencies. The system is falling apart very rapidly. Rising interest rates, in my view, are going to hit particularly the Eurozone banking system very, very hard. Why? Because the Eurozone banking system has expanded its repo position to, we don't actually have figures, but I know that there was a International Capital Markets Association estimate, or I think they went to 50 or 52 large repo banks in Europe and found that the size of the market was over 8 trillion euros. And that was back in 2016 from memory. It's going to be well over 10 trillion now. And so what's driving it? I mean, what's driven it basically is you've got this situation where an Italian bank, for example, can package collateral up, including non-performing loans, which the regulator has signed off as performing, and use it as collateral against a loan from the Italian National Central Bank. At what rate? 0%. Cash for nothing. You know, this is, I can't think of anything more guaranteed to explode demand for a market than free money. So, you know, and from every point of view, you can see why this market has just taken off. Now imagine what happens when you get rising interest rates. That's going to collapse. And when you get a collapse of repos like that, it is the equivalent. It is exactly the same thing as a collapse in outstanding bank credit. And we know what happens when bank credit collapses. The economy tanks, the currency tanks, everything tanks. The central bank steps up and has to, you know, sort of print currency to support everybody. And in the euro's case, I mean, you've got banks, they are incredibly highly geared. I mean, you know, it's not unusual to find banks with assets over 30 times their balance sheet equity. And it's hardly surprising that the market's valuing balance sheet equity at substantial discounts to book value. What's that telling us? That the banks are cheap? No, it's telling us that they're on the verge of going bust. This is not good. And I really do think that rising interest rates is going to trigger a crisis, a banking crisis, sooner rather than later. We will not be waiting to see 15% interest rates. We will see that a long time before that. And I note today that the 10-year US Treasury bond is now yielding more than 2% for the first time in years. So, you know, it's on its way there, I'm afraid.
A few moments ago, you spoke about backwardation in commodity metals, other commodities such as aluminum, copper, that sort of thing. There's a question from Mikey Riley. How could JP Morgan have acquired so much physical silver? In fact, like, for example, there are estimates that it may be the largest hoard of physical silver ever amassed in the history of the world, without moving the market up or causing backwardation? I
think I don't know the answer to that, but I know how they might do it. And you've got to look and see who their customers are. I suspect on one side you have got mining companies. They will lend money to mining companies against a certificate from Glencore or Trafigura about the quantity of silver, say, in the doré that is processed at the mine head. It will probably be refined in China. And effectively, what you end up with is the Chinese government owning the silver, but it will be on JP Morgan's books. I think that's the three, the triangular banking relationship. You've got mines on the one hand, who need cash flow to pay for their miners and all the rest of it. You've got, Trafigura and Glencore and similar assaying experts who will visit the mines and give a certificate as to what is actually there. That allows the mine to borrow money from JP Morgan in order to pay all the salaries and all the rest of it. The doré is then shipped for refining. And where is it refined? In almost all these cases, I think it's refined in China. And so that, if you like, is sort of, while it's being refined, it appears on JP Morgan's books. So you have a situation where JP Morgan doesn't actually own the silver, but it's owned by its customers. And interestingly, quite some time ago, there was all sorts of theories that JP Morgan was manipulating the market and all the rest of it. And I can't remember the name of the lady. There was a British girl who was head of commodities at the time. You may recall her name. And she actually went on a television program and said that they did not take positions, they dealt for their clients. Now, that lady, I'm pretty sure, would not have lied in a public arena like that. She would have, if they actually had been involved with manipulating the market, that television snip would not have happened. I can tell you that for nothing. You know, bankers aren't fools. Traders are fools, bankers are not. So I think that we've got to look sort of a little bit askance at the sort of idea that JP Morgan own huge amounts of silver. And of course, the other thing about it is that they may well have a position which they use to write options against. And they will write options not only on COMEX, but they'll also write them on the forward market in London. So these are OTC options, which can be really quite substantial. So it's what I'm trying to say is that the situation, I think, is a lot more complex than than the idea that you've got JP Morgan going in there and cornering the market.
You also mentioned central bank digital currencies along the way. We have a number of questions around that from multiple viewers. I'll try to just combine them all into one. And that is, do you foresee in the next coming period of time soon the emergence of central bank digital currencies? And do you or do you not think that they will be backed by gold in any of these markets? And how much pressure would that put on the others to follow suit?
I actually wrote about this, 2 or 3 weeks ago. So it might be worth having a look on the Gold Money Insights page to find the article. But very briefly, I think a number of things. Firstly, no bank, to my knowledge, is thinking in terms of digital currencies as being backed by gold. That is not the purpose of a central bank digital currency. I think the purpose that seems to be emerging from all the talks held at the Bank of International Settlements and so on and so forth is that this is a means whereby central banks can increase their control over economic outcomes. Because what happens with a central bank digital currency is that everybody, that's you, me, everybody, has an account at the central bank. And businesses have accounts at the central bank. So, by doing various things, for example, having issuing digital currency which expires valueless after a period of time, you can encourage people to spend that. You can also say that the digital currency can only be spent on the following things. And so you can target, if you like, your stimulus in certain directions and so on and so forth. And the other thing is that because they know exactly who has what they're doing with it and all the rest of it, then it does mean that they've just got complete control and you've lost all your freedom. So this is actually a very serious thing. And just imagine, I'm sort of thinking about the American situation. You have a political system which is funded by commercial banks. So we're talking about a central bank digital currency which is going to take commercial banks' business away from them. Are they going to lie down and just sort of let this happen? The answer is no. And I think the easiest way for them to say no is to remind the politicians who they bankroll, who their paymasters actually are. So I don't think you get the legislation passed in America at all. And that's before we consider other things like how would that affect the federal dollar and all the rest of it. I mean, that's, we're not even getting to that point. So you can see that with all the bureaucracy that's required to satisfy everybody that this has been tried, tested, it's cyberproof and all the rest of it, probably take 2 or 3 years. And the banks will turn around. And the reason you haven't heard anything from the banks is they're holding back on this until they've got something actually to attack the political class with. It's not going to go through. It won't happen. So I think that's the first thing. The second thing is that the idea, I mean, a lot of people are touting central bank digital currencies as part of a reset, if you like. And the mistake they're making is if you're going to have a reset, I mean, are you going to trust someone who's just collapsed their own currencies with a new currency? I mean, I think the answer is no, because the underlying problem is not the currency, it's the loss of the full faith and credit in the issuer. So it doesn't matter whether it's a central bank digital currency or, an existing central bank liability in the form of dollars or pounds or euros. This is not going to last if it was ever to be introduced. And then finally, I come back to my point, and that is the real issue now is we have got rising interest rates, which are out of control. The central banks can't control it, and it will break the system. And that is something that's going to happen in a matter of months, possibly even weeks. We don't have the luxury of 2 or 3 years or even 5 or 10 years to sit there and plan this thing out. I'm sorry, that's not going to be the case.
We've asked you this before, but I'm going to ask it again. When you say that people will be unwilling to accept or trust the same powers that be that broke the last currency system and lost faith and trust of the people with the new one, what choice do we have if the laws are passed that say that's the only medium of exchange that's lawful? What has history shown us about what happens in times like that?
That is the current situation. I mean, if you want to buy something, you've got to use lawful currency. That is not the problem. The problem basically comes when you and I and all of us collectively decide that hanging on to dollars, or in my case, pounds, liquidity so that I can go out and buy things I need tomorrow and all the rest of it is complete lunacy because it's going down to zero. That is the problem. I mean, we're going to drive ourselves into a situation where money doesn't work anymore. But are you going to stand there against the tide and say, well, I'm going to make sure it works alone? No, you're not. You're going to run with everybody in the same direction, and that is get out of it. And that is the problem. It's not a question of personal choice. This is going to be a stampede out of currency. I don't think it'll happen immediately, but you will see the system beginning to fall apart. The first thing that will happen is that rising interest rates undermine financial asset values. You'll find that obviously, government bonds will start yielding significant amounts of money, fundamentally undermining government finances. You'll find that equity markets start falling. You'll find that all the cross-border investment starts returning home, or certainly coming out of equities. I mean, think, foreigners own something, I can't remember, I think the last figure was something like $13 or $14 trillion worth of US equities. Why do they own them? They own them because they think they're going up. They don't have to own them. They have to own their own domestic equities, yes, but they don't have to own foreign equities, which is what dollar-denominated equities to a foreigner from, someone who's foreign to the United States. That's what it represents. He's only there for profits, and as soon as that goes, he's out, I can tell you. So you're going to see, and also Americans investing abroad. I mean, Americans have got very little in the way of foreign currencies if you look at the US Treasury tick figures, but they do have significant investments in foreign equities and if you like, dollar-denominated things owned by foreigners. So on that basis, you're going to see flows coming back into America as well. But is that going to go into equities? Well, what it will probably do is some of it will go into equities, because what happens is you sell the foreign stuff first in order to protect your backside at home. So, there will be a bit of that going on. But this is not a happy situation. It really is not. I just hope I'm wrong, but I cannot see how we can get out of this problem.
Well, Alasdair, we have more questions than we have time to get to today. And as always, on behalf of all of our viewers, I just thank you for joining us on Liberty and Finance, sharing your insights and your forward-looking analysis. We'll put the link in this description of this video to the article that we were discussing today, including the figures, so people can peruse that at their detail. You have footnotes below that as well. And just thank you, as always, for joining us here on Liberty and Finance.
That's my pleasure. And while you're on the Gold Money website, have a look and see whether you might think it's a good idea to open an account and get some metal stored maybe in a foreign country away from your government, remembering the Roosevelt era and so on and so forth. So, I mean, it might be worth having a think about that. Think about the problems. I think that's the great thing. That's the message. I want people to think, to understand. Don't listen to me. Just sort of pick up a German, perhaps, of what I've said and examine it to death. And if you come to a different conclusion, fine. You will have, that's your affair. But I would encourage you to think. And I think, if I'm right and it all goes wrong and you didn't think it through, then you've only yourself to blame.
Also, folks, just to let you know that if you don't want to miss a single interview with Alasdair or any of our guests, make sure you sign up for our free newsletter at libertyandfinance.com. Put in your name, email address, submit, confirm with the email that we send you, and you'll be in. You'll receive every single link to every interview on all of our social media platforms, not limited to YouTube. So, Alasdair, thank you for joining us again here on Liberty and Finance.
That was very much my pleasure, DK.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.